All right, friends, welcome to this week's program. So glad that you're here. My name is Jerry Robinson, the host of Follow the Money Weekly on the web at www.ftmdaily.com. So glad that you're here, taking time out of your week to spend with me and our team as we dissect what's happening in the U.S. and global economy. This week, a little bit different. Going to be tackling an article that was written in the Wall Street Journal at the end of May. Really lit my fire. I tell you what, it almost seems as if I should be used to the biased information and the sales opinion and the sales hype that exists in the mainstream media. But I tell you, I still get upset whenever I see the majority of people falling for the propaganda that comes out of Wall Street that is posing as good, sound financial wisdom or financial planning advice or whatever. So we're going to tackle an article in just a minute. I tell you what, the markets this week have been very, very difficult. The last 6 out of the last 7 weeks, the market's been down. This week, for the first time, the market actually had an up week. But I tell you, it didn't feel like it, even though it ended up. It pretty much traded flat, up and down all week long. Very difficult for investors. And FYI, those of you who are part of our subscriber base, our FTM quarterly subscribers, be watching your emails and the website on Monday, as I'll be releasing some new market commentary, what to expect in the months ahead. Also, a brand new update on all of our FTM investment portfolio stocks and ETFs, some of our new buy and sell actions. Be putting that out on Monday. If you're not currently a subscriber, you can do so. The prices are going up, so you might want to hop on and do that quickly over at ftmdaily.com. But anyway, be looking for that. All of our subscribers, I know that you definitely like market commentaries and you want to know what we're doing with our own portfolio. So be sure to tune in Monday to the website or check your email. You'll see we'll be putting out a report on that day. All right, look, I want to get into this article. I was reading the Wall Street Journal, as I do each and every day. Have been a subscriber and read the Wall Street Journal as often as I possibly can. Obviously can't read the whole thing every single day, but I tell you, it is certainly a guide to what's happening in the financial district. And also, I like Investors Business Daily. I also like the Financial Times out of London. Not that these are not biased in their recommendations or in the way they state certain things, but nevertheless, it's important to keep yourself educated. It was a Saturday. I remember I was at my home and I picked up the paper and I was just outraged. I was outraged at an article. Here's the headline. Honestly, what's the best policy? I'm holding the paper right here in my hand. You hear it in the background. I'll be reading. I'm just going to read this. I'm going to read it and comment on it. And then as I do, when I finish, I'm going to bring on my good friend, author of the book, The Pirates of Manhattan, Barry James Dyke. He's one of our Christian financial advisors. Excellent advisor, been in the business for many years, and really has a grasp on what's really happening in the economy. Called this economic crisis back in 2007 in his own book, and really will just great information. I recommend his book. I also recommend that you check out the webinar that he and I did not too long ago. You can go to our website and search for Barry's name, Barry James Dyke, D-Y-K-E, and you'll find the webinar that we did not too long ago. It was free to the public. Okay, I'm going to read this article and comment on it. It's titled, honestly, What's the Best Policy? Insurance agents are pushing pricey permanent life aggressively. Here's what you need to know. Okay? As I read through this, I just underlined and highlighted and made notes and comments. This is a classic example of how the mainstream media pushes what it wants to push and slams what it wants to slam. Okay, well, I'll begin. There's a picture of a nice couple here. Misty and Richard Knight, two Pennsylvania college professors, pictured with their daughters, bought two $225,000 whole life policies last year to supplement their own term life coverage. has a picture of their smiling faces. And the article begins by Leslie Schism. And here's how it opens. Insurance agents have a story that they can sell even harder than usual. But that doesn't mean that you should buy it. The recent market meltdown breathed new life into a much maligned financial product, permanent life insurance. Part insurance policy and part savings account, permanent life's main benefit, safety, has suddenly become a big part of the pitch. While sales of term life, the bare-bones, low-cost insurance that young families have favored for decades, declined by 12% in 2010, its third consecutive drop, permanent life is heating up. One variety, whole life, saw sales rise by 2% in 2010, according to industry-funded research firm LIMRA, while sales of the other type, universal life, surged 21%. Now, let me kind of fill you in real quickly on what we're talking about here. There are several different kinds of life insurance, but basically there's two when you boil it all down. There's term life, which is the insurance that you rent. You rent it because eventually it's going to go away. You can buy a 10-year term, a 20-year term, a 30-year term. But whenever it's over, it's over. And then you also have permanent life insurance. That comes in different flavors. You have universal life, which offers flexibility. You have whole life, which provides a very level premium over the entire course of your life, which builds cash value, as does universal life. All these permanent policies tend to have the ability to accumulate cash value. Now, let me explain something real quickly before we go any further. Wall Street and those who work there and those who run firms there, they do not like competition. They do not want anyone coming in and competing with them. And financial planning itself was created by life insurance companies. The whole entire career, the whole entire process was started by insurance companies. Insurance companies which have been around mostly the 1800s, the mid-1800s especially. Many of the mutual companies popped up, and they sailed through the Great Depression, and they still exist to this day, very solid, firm companies. And Wall Street has created all kinds of different exotic products, and some not so exotic, designed to take your money. You have to understand the financial institutions want your money on a consistent basis, and they don't want any competition. Stocks, mutual fund managers, these guys who put together stocks into mutual funds and they want to manage the money, they want your assets under management, they want to collect a fee off of you each and every year. They do not want you to look at anything else. And so it wasn't too long ago, a few decades ago, that a gentleman who was basically the beginner of the buy term and invest the difference process underneath the name Primerica came out and taught that if you would take your money and buy term insurance with it and then invest the difference into mutual funds, you would succeed. Okay? And then, of course, Dave Ramsey and Susie Orman and every other, Rick Edelman and all these other guys jumped on the bandwagon and said, absolutely, that's great. And so the problem with all that is that if you take a look at the buy term and invest the difference concept over the last few decades, you'll find that it has really been a losing proposition. Now, here's the deal. When you put money into a cash value or a permanent life insurance policy, these things are expensive. They take more money than a term life insurance policy. And here's the problem. Most people only have so much money to put into financial products. And Wall Street knows this. So the buy term and invest the difference was a way for them to get you to put your money into mutual funds. Now, obviously, life insurance companies would prefer you to buy a cash value life insurance policy, right? Everybody has their own incentive. But what's happened here is that cash value life insurance, which has been a very stable form of holding cash, a great forced savings vehicle, paying dividends or interest, depending on whether the company is a mutual company or a stock company, and providing a death benefit for you in the event that something happens to you, That's a wonderful thing. And nevertheless, Wall Street has greatly maligned it. And what bothers me about this article as we go through is it calls it the much maligned financial product. Well, who maligns whole life? Wall Street Journal. These people, these same people who are telling us, oh, it's so maligned, they're the ones who do it. The mainstream media is the one who does it. Let's continue. While insurance agents are quick to tout permanent life's virtues, in part because it carries high commissions, okay, are you hearing this? The factors driving the decision of which insurance to buy haven't changed because of the financial crisis. For most people, now listen to this. Here's the Wall Street Journal giving it financial advice. For most people, term life insurance still offers the best combination of coverage and cost. But for some wealthier folks looking to build tax-deferred savings, permanent life can be a good option. Okay? Now, I can tell you over and over in this Wall Street Journal, they tout tax-deferred savings. They love 401ks. Dave Ramsey loves 401ks. Susie Orman loves 401ks. Why? Because they're tax-deferred. Right? Well, this Wall Street Journal says, now some wealthier folks may want whole life because it builds tax-deferred savings. Well, only wealthy people would want that, right? What? Tax-deferred savings is what they push all day long in 401ks. And you know what the difference is? Mutual funds get that money in a 401k. Mutual funds get that money in an IRA. When you put it into a whole life product, guess what? No mutual fund gets it. But it's still tax-deferred. Amazing. Absolutely amazing. And then it says, still, for most people, term life insurance offers the best combination of coverage and cost. I'll tell you in a minute, term life insurance is the most expensive insurance you can ever buy. Term life, here, I'll continue. Term life provides a death benefit for a specific period, as we said, you basically rent it, for such as 10, 20 years, and premiums are generally set at a flat rate. Then they say only a small percentage of the policies sold to people in their 30s and 40s ever pay out. Only a small percentage. Do you know how small it is? 3%. 97% of term life insurance policies pay out no death benefit. 97%. Well, that sounds like a gamble. Let me ask you this. If I said, listen, I want you to give me $100 a month, and I'm going to basically, the odds are going to be 3 to 97 that you're going to get anything out of it. You want to do that? Now, you tell me, which is more expensive? That, or if I said, give me $300 a month and you're guaranteed to get something. Which one would you prefer? Would you want the guarantee, or would you want the 3% chance of getting a return? So they don't include that number because, understand, the Wall Street Journal, by the way, there is a mutual fund ad on this same page. Friends, the mutual funds run Wall Street. More than that, they run the universe. Notice on every single channel that you watch, the mutual fund companies, they want your money. It's all over the place. Okay, so they have certainly won the war, but only a small percentage, the story says, of policies sold to people in their 30s and 40s ever pay out. Permanent life is meant to be in place your entire life, paying out upon your death whenever it is. Until recently, permanent life was widely considered stodgy, needlessly complicated, and a bad bargain to boot. Who considered it that? I want to know where they came up with this. Who considered it stodgy, needlessly complicated, and a bad bargain to boot? If that's the case, then I want to know why every single executive at Citigroup and many of these other companies have permanent life insurance and not term. If it's so stodgy and such a bad idea, I want to know why many of the corporations at the highest levels, the top executives, have permanent, not term. Give me a break. Let's keep going here. Well, this article is just getting warmed up. It's a bad bargain, it says, and then hefty agent commissions and other costs and the slow buildup of value in the savings account also make it a bad bargain. I hate to break it to you, but the commissions on a term life insurance policy are exactly the same percentage as a commission on a permanent life insurance policy. It's the same percentage. If you sell a house, it's $30,000, or if you sell a house that's $30 million, you're going to make about 6, 7, 8%. Usually about 7% is what the industry standard is. It's the same way in life insurance. You don't get more of a percentage if you sell permanent insurance. You get the same. Now, there's more dollars going into it, so you are going to make a higher commission, so to speak. But that's not a good enough reason. It's not as if term insurance pays a lower percentage commission. Then it goes on. The accumulation of the cash in the permanent life insurance is so slow, it says, in part because commissions typically eat up the first entire year's premium. Well, that's the same way as it is in term. And then they run around 5% per year for the next few years before dropping off. All those caveats, they're caveats now, generally still apply, but sales have jumped as life insurers have done a good job promoting permanent life's safety benefits and playing on consumers' fears about the stock market. Consumers' fears about the stock market. So basically, these insurance agents are out there and they are promoting permanent life insurance safety benefits as if that's something new, and they are playing on consumers' fears about the stock market as if that's not completely justified. Stockbrokers are playing on consumers' fears, let alone insurance agents. Do you know who shows up at your door whenever someone in the family dies with a check? It's a life insurance agent. Everybody else shows up with bills. Unreal. Under the hottest selling types of permanent life, the savings component is invested in bonds, which generally held up well during the market meltdown. Big sellers of permanent life, such as Guardian Life Insurance Company of America, Massachusetts Mutual Life Insurance Company, New York Life Insurance Company, Northwestern Mutual, and TIAA-CREF, continued paying healthy dividends or interest to their policyholders throughout the economic crisis, a feat some have noted in recent marketing campaigns. A feat that some have recently noted in marketing campaigns, as if it's something that this is what they always do. Because insurance companies cannot loan out 95% of their money like banks can and like other financial institutions can. They pay out dividends because they are forced by the law to be wise with their money. They have to have a massive amount of reserves. And then, of course, here comes the it's not fair by the author, but it isn't fair to compare the stock market crash with the performance of an investment based largely on bonds. An investor could have bought cheaper term insurance and put their money into bonds. He could have bought term and invested the difference, which is exactly what the Wall Street Journal author wants you to do. This writer is begging you, please, it's not fair that people might have bought whole life insurance. Instead, they could have bought term and invested the difference into bonds. It would have been the same thing. Really? It would have been the same thing. Well, let's examine that for a minute. Here, before I do, let me finish the paragraph, his thought. The old argument for buying term insurance and investing the difference still applies, it says. Really? Okay, so let's say that this individual buys a whole life insurance policy, and it's invested in bonds, and therefore it pays a dividend. Well, the death benefit is intact. Let's say that he comes, let's just use Bob. Okay, Bob is going to be the person we're using. He buys a whole life insurance policy, and then it's invested obviously in bonds because that's how the insurer has chose to do it. It pays him a dividend. He sails right through the financial crisis with no problems. And then let's say that he comes down with a dread disease. Okay? And he decides that he wants to take some of the cash out of the cash value life insurance to pay for something. Okay? Well, Bob does this. He borrows the money from his cash value life insurance, and guess what? He pulls it out tax-free. And then Bob goes on and passes away, and then the remaining death benefit is paid out to his heirs, perhaps his wife, completely tax-free. Okay? Now, let's take Bob and let's say that he was wise and he followed the Wall Street Journal approach and the Dave Ramsey approach and the Susie Orman approach, and let's do the same logic. He bought a term life insurance policy because they're so much better and they're so much cheaper. And then he takes the rest of his money and he puts it into bonds, corporate bonds, and he earns that 5%. And then let's say he comes down with that dread disease, and he's bought a 20-year term policy, and he's in year 19 of his term policy, and he comes down with the dread disease, and he wants to pull money out of his bonds. Well, he does. He pulls money out of his bonds, and of course, it's a taxable event. It's not tax-free. And then, let's say he dies in year 21. Guess what happens when he goes back in year 19 and he finds out he has a dread disease and he tries to renew his term? Guess what the term company says? We're not going to insure you. You can't qualify. Insurance companies don't have to insure you. You're not entitled to life insurance. I'm not entitled to life insurance. It's not a right. You have to qualify. And there are typically rules with life insurance that once you pass 60, sometimes 70% of the policy you get through, you are not able to renew it without a health exam. And so here's Bob. He can't renew his life insurance. He dies after it expires, and all he has is the bonds. And they're a taxable event to touch. Buy term and invest the difference, Wall Street Journal says. Oh, it's still the very best thing to do. In short, term life insurance remains the best choice for most people, it says right here, says James Hunt, an actuary with the Consumer Federation of America, a nonprofit advocacy group based in Washington. It is the lowest cost way to get the most coverage for a shorter period, and it is easy to walk away from a policy if you find a better deal or if your needs change, he says. That's absolutely true. Permanent life policies, in contrast, generally need to be held for at least 2 decades for the savings component to beat a bond-based buy term and invest the difference strategy. That's because the savings account expands so slowly, it says, in many of the policies pitched to consumers, thanks largely to big upfront commissions. Can you hear the absolute sarcasm in this article? Many buyers underestimate how difficult it can be to keep up with the high premiums and end up walking away from the policy early. According to the Society of Actuaries, which studied data from the early 2000s, 26% of whole life policies are terminated in the first 3 policy years and 45% in the first 10 years. Well, I want to know how many people bought term and really invested the difference. How many people actually stuck with putting money aside? They may say, well, I'm not going to buy cash value because what I'll do is I'll buy term and I'll invest the difference. Well, how many people actually bought term and then really invested the difference? So the article continues. So why bother with permanent life insurance at all? Can you believe this? The real appeal is that the savings account builds up on a tax-deferred basis. Oh, now we're halfway through the article, and then we hear about the tax deferral. The tax-deferred basis, no small thing to upper-income families who fear rising taxes to pay for the nation's huge budget deficits. Yeah, and not so bad idea for those who are not so rich, because tax deferral is touted as the number one thing. Max out your traditional IRA, max out your 401k, but whatever you do, don't touch life insurance. Why? Because it doesn't go to mutual fund companies. The money doesn't go to them. And who are the primary advertisers on most of these programs and in this paper? Mutual fund companies. The tax breaks are especially attractive to those families who have maxed out a 401k account and other tax-advantaged savings vehicles, advisors say. Much of the money can be pulled out without triggering any taxes whatsoever. Are you kidding me? Do you know how many people would love to know this? Much of the money can be pulled out without triggering any taxes whatsoever, assuming the policyholder is careful about following the rules. Tax-free. But only rich people want that. Only the rich people would want tax-free money. For most people, Buy term and invest the difference. Give the money to the mutual fund companies, buy term, and get a 97% chance you will never see the death benefit. Put your money in mutual funds and lose the difference. Are you kidding me? Who buys this stuff? 95% of Americans reach the age of 65 dead or dead broke. Why? Because of garbage like this is passed off as good financial planning advice. Do you know who came up with this stuff? The mutual fund companies. They're selling you this stuff. Buy term and invest the difference. It's the very best way for you to succeed. Really. 95% of the people are failing. And it's the best way. This is the best we can do. The article says, much of the money that's put into these cash value permanent life insurance policies, which are touted with many, many benefits of safety and are pushed and pitched by insurance agents, the money is pulled out without triggering any taxes whatsoever. Only the rich would want that. All right, we continue the article. In considering a permanent life purchase, you need to think through how long you need the coverage to be in force and make a wise decision that your cash flow will be enough to pay the required target premium, says Victor Murrow, who runs Financial Integrity Strategies, Inc., a New York insurance and investment advisory firm. The difference in premiums, the article continues, can be stark. Now listen, here we go. They're going to give an example. A 37-year-old man recently could get a $1 million 20-year level term policy for as little as $495 per year. By contrast, a low-cost universal life policy from Tia Kreff could cost the same man $4,933 a year in premiums, though at the end of 20 years, this consumer would have about $150,000 in the cash account, based on the insurer's current 5% interest rate. Okay? Did you catch this? A 37-year-old man recently could get a $1 million policy for 20 years, 20-year level term, for $495 per year. Okay? So let's say he does that. He's going to pay $495 per year for the next 20 years. Let's just round it off to $500, and that's about a $500 a year times 20. That's about $10,000. So over the course of 20 years, he's going to pay $10,000 for this $1 million death benefit. If in the course of that 20 years he dies, which there is, according to the stats, a very, very large percentage chance that he's not going to, then he will receive nothing. And if he gets sick towards the end of that policy, he will not be able to renew it without a health exam, which means he may never be able to get life insurance again. And this thing is going to be expiring around the age of 57. Now, it says, by contrast, a universal life policy, which costs about $4,900 per year, would be worth about $150,000 in cash value at the end of 20 years. So let's see. In this case, it's $4,933 per year, so let's just round that off as about $5,000 per year. And if we paid $5,000 per year, we would pay about $50,000 every 10 years, about $100,000 every 20 years. But this says that we'll have $150,000 in cash after 20 years. So you made $50,000 by choosing to go with the universal life policy, and you have a permanent life insurance policy, which no matter what happens to you, will stay in effect. Or you can give the insurance company $10,000 and have a very small chance that you'll ever need it, and possibly never be able to get insurance again if you get sick during the last 30 to 40% of that term. All right, the story continues. So how would a buy term and invest the difference strategy fare versus a permanent life policy? Here it says, the term life buyer would take $4,438, the difference between the term life and the permanent life premiums, and invest it steadily. I don't know anyone who does this, but let's say that they did. Depending on his returns and tax rates, he could lag behind or come out ahead. Let me rephrase that. It's a gamble. For example, If he invested the money in bonds and earned a 5% annual return after 20 years, he would end up with $126,306 after taxes, assuming that he was in a 35% tax bracket, according to financial planner Alan Roth in Colorado Springs, Colorado. If he invested into a stock portfolio that earned 8% annually, he would come out with $180,812 after taxes, assuming a 15% long-term capital gains rate, but he would have taken more risk. And if he bought the permanent life policy and cashed it in after 20 years, he would net $134,686 after taxes. A couple of points to bear in mind, the article continues. If the permanent life holder cancels and pulls out all the cash value, taxes would apply to any gains at ordinary income rates. On the other hand, if income or capital gains tax rates were to rise, that could tip the balance towards permanent life. So what I want you to see is that term life insurance, before I continue this, term life insurance is pure cost. It's pure insurance. There's nothing wrong with term insurance because it actually serves a wonderful purpose. Your human economic life value is determined based upon your earning power and many other factors. If you're 20 years old and you're going to earn $50,000 per year projected for the next 40 years, then you're determined to be worth that, 50,000 times 40. And a insurer will look at you that way and say, this is basically what you're worth. You can't walk in at that rate and say, I want $1 billion tax or $1 billion life insurance policy. They'll obviously not be able to do that, nor could you afford it. But the truth of the matter is that term insurance is good because it allows you to reach the death benefit that you need. But what's interesting about these articles is that they assume that term is always best for everyone and that cash value is always bad. The permanent life insurance is always bad. And that is simply unfortunate, and that is driven largely in part by the competition that exists on Wall Street regarding financial products and your money. All right, so the story goes on, and they have the audacity to say this. Listen to this. I had to highlight this. So now, after they've said all this, they say, here's a guide to helping you shop for life insurance once you decide which kind of policy is right for you, as if they haven't already told you over and over and over that you would be an absolute moron to buy anything but term and then invest the difference. Now they're going to give you a guide. They're going to be your financial guide. They're going to hold your hand and lead you into the truth about this information. When it comes to buying term life, they say there's usually a gamble involved. Here, this is, by the way, at the very end of the article. They haven't told any of this up to this point. They say there is usually a gamble involved. A 10-year policy will have a lower annual cost than a 20-year one. But if you will become ill and still need insurance at the end of the 10 years, buying a new policy can prove costly if you can even get one at all. And of course, they leave that part for the very end of the article. Also, when it comes to buying permanent life, here are some of the comments that they make. Permanent life policies vary widely across the industry and are hugely difficult for ordinary consumers to understand, much less compare. Okay, so we've already basically said you won't be able to understand it. They're hugely difficult. They're highly complicated. Ordinary people can't understand them. But if you still want to buy one, you want a policy, it says, in which the savings account starts building into value quickly. And it says many agents are not likely to steer you in this direction because it will cut into their commission. Unreal. The Wall Street Journal, The Guardian, for your financial future, telling you to avoid cash value life insurance because it's tax deferred and tax free, and only the rich people would want that. And they're hugely complicated. You will never be able to understand it. Just put all your money in mutual funds and everything will be fine. Buy term and invest the difference. And then when you do buy cash value, they say, don't trust the insurance agent. He's probably going to steer you in the wrong direction anyway. It goes on many policies are pitched by agents, and the premiums from the first year or two are mostly eaten up by costs, leaving little for the savings component. Isn't that amazing? You buy $1 million policy for, let's say, $500 a month, and much of it's going to cash. But for the first year or two, it says here in this article that most of it's going to go to fees, those silly fees. Okay, let's use the Mack truck theory for a minute. You go down to your sleazy insurance agent who is going to steer you in the wrong direction because they're all crooks, according to the Wall Street Journal. And you say, I want to buy $1 million life insurance policy. And he qualifies you. He basically does it. You have to do a health exam and all this. And it comes out, it's going to be $500 a month, $1 million, universal life, whatever it might be. And let's say you make your first premium payment and then you get hit by a Mack truck. What does the insurance company owe? $1 million, payable tax-free to your heirs. And then the Wall Street Journal has the audacity to say, well, the $500 that you're going to pay for the first couple of years are going to go to fees. Well, what in the world? The insurance company has locked itself into paying you $1 million. This is a permanent life insurance policy. They cannot get out of it unless you do. They are required to pay $1 million for your measly $500 payment every single month. Yes, there are fees. Unreal. The costs means that it can take 7 or more years before your savings equals what you have paid in premiums, less the cost of the death benefit. This is not a savings account per se. You're buying a death benefit. Why in the world would they be equal? It's not like you're putting money into a CD. If you put $500 into the CD, then you should expect $500 to be there tomorrow. But if you get hit by a Mack truck, guess what? You get $500 out of your CD, period. You aren't getting $1 million from your bank's not going to say, oh, he died in a car wreck. We're going to give him $1 million. Just because we're like that. No. You buy a life insurance contract. You pay your $500 your first month. Yeah, of course some of it's going to fees. It's got to pay for that $1 million that they promised to pay you. But they're also going to provide a savings component, which is going to build tax-free for you to tap as in the form of a loan at any time you need to. It's unreal. Friends, this is the kind of garbage that's sold as here's the title of the article again, by the way. If you want to look it up, we put it on our website this weekend. Honestly, what's the best policy? Insurance agents are pushing pricey permanent life aggressively. Here's what you need to know, because these sleazy, quote-unquote, insurance agents are trying to get you to put money into whole life. You've got to be kidding me. Whole life insurance covers you for your entire life. If your goal is to have insurance for your life, then you want it for your whole life. You don't want term insurance to be your permanent insurance because it's not permanent insurance. It'll only cover you for a particular period of time. And if you want to rent your insurance, term insurance is the best. And if you don't have enough money to buy permanent insurance, then term is the best option. But it's not true that the majority of people should never consider permanent insurance. The truth is, the majority of people should not consider permanent insurance for the sake of the mutual fund companies. Mutual fund companies are the ones who do not want you to consider any other alternatives. They hate permanent life insurance for the same reason that they hate gold, for the same reason that they hate silver, for the same reason that they hate commodities. That's the same reason that they hate anything that represents an alternative. They hate real estate. They hate anything that represents a challenge to them getting their hands into your money. They want your money at all times consistently, and they want no challengers. They want no competition. So right now I want to bring on my good friend, Barry James Dyke. Barry is the author of a book called The Pirates of Manhattan. It's an excellent book. If you haven't read it, you can order it on Amazon.com or on his website, thepiratesofmanhattan.com. He is the president, founder of Castle Asset Management, LLC. He practices macroeconomic financial planning, and he is a part of our Christian Financial Advisor Network that's on the web at www.cfanetwork.org. He's an ardent student of Austrian economics, as I am, and he also is a believer in sound money. He's been practicing financial planning for many, many years. Let's bring Barry on right now. I want to get his take on what we've been talking about. Let's go to that right now. All right, Barry, thanks for joining me today.
Good afternoon, Jerry. Good afternoon.
You have spent hundreds, if not thousands, of hours researching, writing about the mainstream medias like this recent Wall Street Journal piece against permanent life insurance. And during your research, and we've had multiple talks about this, you've uncovered perhaps one of the greatest hypocrisies on Wall Street. And that is that they push term, they buy the term and invest the difference, while they actually own massive amounts of permanent life insurance at the highest levels in their corporations. Explain in simple terms, Barry, why Wall Street has done what they have done.
Well, they're just interested in making money, Jerry, plain and simple. If the American consumer doesn't get that now, that's the reason why they're interested, what's good for them. But the truth of the matter is that they like to push term insurance because it's the highest actually fee income for them over the long term. And but the fact of the matter is that these major banks, i.e., the greatest example, the greatest contradiction, as you know, and this is posted on YouTube as well, and it's been up there for a couple of years, is that Primerica, which has been a part of Citigroup for years, actually tells people the only thing they should buy is buy term and invest the difference. But we're in the fact that Citigroup itself, the bank, has over $4 billion of its Tier 1 capital invested in life insurance, high cash value life insurance. So it's the ultimate hypocrisy with Citigroup, and I get a kick out of that. And although Primerica has been spun off, the reason why I bring this up, Jerry, because Leslie Schism in this article brings up about Primerica, and if she did her research, she realized that Primerica is still part owned by Citigroup, although the other part of it is owned by the private equity arm of Warburg Pincus. But the truth of the matter is that Citigroup has cash value life insurance on its own books, but Primerica, which has long been a part of Citigroup, has been pushing term insurance, and it's tragic. But people don't know what to believe in anymore, and but that's all true. And the same thing, all the other major banks, the J.P. Morgans, the Bank of America, the U.S. banks, the Bank of New York, Mellon, all these banks have huge, colossal amounts of high cash value life insurance.
Yeah, and the folks who want to kind of follow up on that can check out on our website, ftmdaily.com. You and I did a webinar on this topic. We went in depth. And if anyone who is listening has not seen that webinar, it's available for free on YouTube, but it's also available at our site, ftmdaily.com. Just do a search for Barry James Dyke. That's D-Y-K-E. On ftmdaily.com. You'll see the webinar that Barry and I did on this same topic. Barry, it's weird because what gets me is term insurance really has its place. It really does.
Oh, yeah. No disagreement in that at all, Jerry. I mean, it's still limited, the planning I do today, I still recommend it. There's nothing wrong with term life insurance at all. It's just that they're saying this is all bad, and then when you do the amount of research I have and you have, you realize it's one of the only financial products that works. The other stuff doesn't work. It's all falling apart.
It consistently pays a dividend or interest depending on the way the company is set up, and people, of course, even the interview here even says how the people who owned it sailed through the recent financial crisis without any kind of blip because the dividends kept being kicked out, because these insurance companies operate in a different way. They're held to different standards than banks are. Talk about the difference between insurance companies and other financial institutions in the way that they are required to have reserves.
Okay, well, essentially, the thing with all banks are essentially highly leveraged. They're all highly leveraged, and so by very nature, and this is in my book, but they're all by nature very highly unstable because they're very leveraged. During the normal times, banks are leveraged 10 to 1, 15 to 1, and during the financial crisis, they were leveraged 40 to 1, and so forth. And some of it, with the off-balance sheet assets, it's even worse. But so for that reason alone, banks are they're creaky, and all of them are. They all are. Whereas conversely, if you put money into a life company, they're not leveraged. It was called 100% reserve base. So if you put $1 million into a life company, they only lend out roughly $900,000 1,000 of that. Whereas if you put $1 million into a bank, they'd be levering it out through, 10 million, 15, 20, 30 million. It's disgusting, but the amount of leverage, and it still exists today, Jerry. The leverage and the derivatives and so forth, there's still the same signatures still exist in the banks today, and they've gotten even bigger.
Yeah, and as we went through this article, it's interesting how the writer of this article does not bring this out. All they simply do is point at the fact that term life insurance is quote-unquote cheaper, that it makes more sense for more people, but they leave out so many important details, especially how cash value life insurance, you have the ability to get that tax deferral and then obviously touch the money later in a tax-free way if you follow the rules. That's a huge benefit.
Oh, yeah. I mean, so that's why Bank of America, say what you will, they have over $20 billion in cash surrender value on his books. And when Ken Lewis, the CEO, walked out of Bank of America, thank you very much, he walked out with an $83 million retirement package. That's pretty good, I think, Jerry, don't you? And $83 million, and a lot of that's backed up by the bank-owned life insurance and annuity, a fixed annuity from the bank-owned life insurance. So this is all true, as you know.
So you mean they didn't put term insurance in his pension plan? That's bizarre.
No, sir. They had permanent insurance on his life, on split dollar. They had permanent life insurance on his for deferred compensation and permanent life insurance for just as a general asset of the bank. So this is the truth, and but the Wall Street Journal, a lot of it, they have a lot of great reporting. But this article is really only one-sided.
Yeah, I agree. I mean, they do a great job on many things, but this bias comes out whenever they begin to talk about, insurance in particular. And you've done a great job in your book, The Pirates of Manhattan, and of course some of the forthcoming works that you have coming out as well. And even in this webinar we conducted recently about, Dave Ramsey, Rick Edelman, also Susie Orman, who consistently slam anything having to do with insurance companies that might mean that a lion's share of a consumer's money might end up in an insurance company as opposed in the pockets of a mutual fund manager. It's amazing how much information you've been able to display about the hypocrisy of these people.
Oh, yeah, and the greater problem is, Jerry, and this will be coming out in Pirates of Manhattan, too, the greater tragedy of all of this, and it is tragic, and it will come out into the daylight, is that these mutual fund companies, the asset managers, essentially control the savings, and their returns have been horrible. And I've actually analyzed this. This is all true, and it's a matter of public record. News Corporation, Fox News, which owns the News Corporation, which owns the Wall Street Journal.
Wall Street Journal.
They have a large part of their own retirement funds in Fidelity Friedman funds, and this will come out in the public in the daylight. But the returns on these things have been horrible. So the stock market is an illusion for most of these people, but because these papers, the media in particular, get so much advertising revenues from the asset managers, the Fidelities, the Vanguards, what have you. They really more criticize it. And the worst thing is that actually News Corporation has a lot of their own people in this stuff. Mm-hmm. So she doesn't even really know what she's talking about in her own company. But I do, and it's a matter of public record right now that between News Corporation, Fox, which is this is as of the end of 2009, they have $200 million in these mutual funds, which really haven't performed, Jerry.
Wow.
They haven't performed.
Well, Barry, you and I recently contributed to a book together, you and I and several other authors, a book that will be coming out very shortly. And you've also discussed with me an upcoming book, which you just recently mentioned, which is going to include your latest research on the backroom dealings on Wall Street. When is that book expected to be out?
Well, it's funny you should mention that I'm picking up a rough copies of the manuscript today. Actually, they're being printed up at Kinko's today, and then they'll be going to various parties. But it will be coming out this year, and I'm sick of looking at it at this point. But it's been working on 4 or 5 hours a day for the past 16 months. So, but it's what's needed out there, because what people understand is that their savings it's not a road to serfdom. It's what I would call a highway to serfdom. And what people don't realize, is that these fund companies are actually using people's savings to support the empire. And it's tragic, but most people don't understand this. And what is even more tragic is that the media companies are actually have their own rank and file employees in these things.
Well, it's just absolutely shocking what the Wall Street Journal has done here. And, Barry, as you well know,
they do a lot of, on their fence, they do a lot of great research, too. But, I mean, a lot of it's very biased.
A lot of places, a lot of media outlets have done the same thing. And, it's unfortunate, but at the same time, guys like you out there who are kind of leading the charge to help people understand that, sometimes these mainstream media folks are not necessarily looking out for people's best interests. Maybe people should not be taking all of their advice from things like the Wall Street Journal. Perhaps they should actually sit down with a trusted financial advisor. And that's exactly why we created the Christian Financial Advisor Network, which you're a part of. You are up in New Hampshire, and we're very grateful that you're a part of that. If people who are listening would like to speak with you about perhaps they have a term policy and they would like to maybe look into a whole life policy, or perhaps they don't have any life insurance at all and they want to talk with you about that, how can they do so?
Yeah, well just, as I say, have them go to the website, cfannetwork.org. That's really the best way to get in touch with me. And, I'd be happy to talk to them and help them, happy to have them get a copy of my book just to get the truth out there. Because it's not just about us, Jerry. It's about our kids and their future and everyone else's future. And the truth really needs to get out there. And so I'm passionate about it, as you know, and I've been blessed. And with God's blessing, I really need to get this information out there because everyone's going to benefit. And hopefully that will be the case. And I'm confident it will be.
I am really grateful for your hard work and what you're doing and all your research, and I really look forward to having you back on the program soon. Take care, Barry. I appreciate you.
Take care. Thank you. Bye-bye.
All right, friends. Well, once again, if you'd like to get in touch with Barry James Dyke, simply go to www.cfanetwork.org. You can fill out the free brief online form, and he'll be in touch with you within 3 business days if he covers your area. It sounds like he's going to throw in a free book if you do that, so kind of a good deal. So simply go to cfanetwork.org. All right, on the other side of this break, when we come back.